Today, it's all about mortgage lending. Hello again, it's Martin North from Digital Finance Analytics. Welcome to latest post covering finance and property news with a distinctively Australian flavour. Today I want to look at a recent RBA speech and also discuss the latest credit aggregates that the RBA released just before Christmas. Now, the RBA speech talked about whether the banks were hiding problem loans. And indeed, as reported by Mortgage Business, the RBA has issued a warning to lenders regarding deferrals and the, quote, two new big challenges facing Australian banks. In a virtual speech to the University of New South Wales 33rd Australasian Finance and Banking Conference, the head of financial stability of the Reserve Bank of Australia, Jonathan Kearns, touched on the shift in the banking sector's challenges due to the pandemic, focusing on the impact of low interest rates on bank profits and loan repayment deferrals potentially, quote, hiding problem loans. With Aussie banks' balance sheets stronger than they were prior to the global financial crisis, with the average Tier 1 capital ratio for Australian banks increasing from 7.5% in 2007 to almost 14% today, Australian banks are also profitable, said Mr. Kearns. In 2019, the combined profits of the banking system were $34 billion and their return on equity 11%, and that exceeds their cost of equity, he said. Mr. Kearns went on to say that the strength of the bank's balance sheets, along with a low level of interest rates and regulatory accommodation, has enabled banks to provide loan repayment deferrals to households and small and medium enterprises. However, he warned that the resilience of the banking system up till now doesn't mean that risks have passed. We've had the largest contraction in global output since the Great Depression, and as that impairs some households and businesses' ability to repay their loans, the liquidity phase of the crisis is giving way to a solvency phase, he said. As such, he set out the two new big challenges for Australian banks: their resilience to a large economic downturn and the impact of low interest rates on their profits. According to the RBA's head of financial stability, at the peak, 10% of housing loans and 70% of SME loans had deferred repayments. With the economic contraction less severe than was initially feared and the recovery underway, many borrowers have resumed loan repayments, and now only a little over 3% of both housing and SME loans have repayment deferrals, he said. The initial perk of hibernating the repayments of borrowers facing temporary liquidity strains was to avoid unnecessary defaults, the impairment to banks' balance sheets, and adverse long-run effects. Loan deferrals also avoided the asset fire sales that can result from borrowers who are in or near default, he said. However, it's important that loan repayment deferrals are temporary and are not used to hide problem loans, he warned. APRA published detailed information on loan repayment deferrals by institutions so that investors can, quote, accurately assess banks' financial health. While there is necessarily uncertainty around any stress testing results, they do point to Australian banks being very resilient, he said. Intuitively, why is this? Well, even if the probability of default increases substantially, 60% of banks' loans are mortgages, and current dynamic loan-to-value ratios are not high, reflecting moderate initial LVRs, the accumulation of scheduled and excess loan repayments, and property price growth. So loss given default is not extreme, even with large housing price falls. But Commercial real estate exposures, which often cause large losses, are relatively small also at the Australian banks, at just 6% of assets, down from 11% during the GFC, and even higher shares in the 1980s and 90s. In addition, LVRs for commercial real estate are typically just over 50%, and loans for property development require a substantial share of pre-sales. And you noted that even if the probability of loan defaults rises, the fact that the majority of mortgages held by banks aren't those with high loan-to-value ratios, they have an accumulation of schedules and excess loan repayments and are witnessing property price growth, so losses shouldn't be that extreme, even if prices were to fall. And the impact of an extended period of very low interest rates will also have an impact on banks' profits. He told delegates that interest rates are likely to remain low for some time, echoing the governor's comments that the Reserve Bank Board is not expecting to increase the cash rate for at least the next 3 years. And Mr. Cairns went on to state that bank profits also benefit from the low interest rate environment, explaining that central banks had cut their policy rates to exceptionally low levels during crises because of large negative shocks to output that resulted in significant spare capacity. Had they not done this, then output would have been even weaker, loan portfolios would be even more stressed, and banks would have incurred larger credit losses, he said. So the first thing to note about low interest rates is that they indirectly contribute to higher banking profits by stimulating economic activity, he said. But what he didn't say but should have said is that according to research from Europe, low interest rates force margin compression on the banks, which makes it harder to lend. They are unable to take deposit rates below the lower bounds, and it forces banks to take on higher risks to try and drive profitability, including trading activity and also potentially writing loans that should never have been written in the first place. So I think Mr. Cairns was rather myopic in his analysis of what's going on, but his warning about the risk of defaults in the system is dead right. And I think we're going to see more of this as the moratorium on defaults goes away. And of course, now directors will have to take responsibility for trading activities, and the ability to wind up companies and SMEs is coming back on stream now. So expect to see higher losses ahead. And his point about the fact that higher prices for property insulates the banks is also, of course, one of the reasons why we're seeing massive amounts of money flowing into the economy, specifically into the construction sector and specifically into the property sector, to try and keep property prices up. As I've said several times, the whole strategy for the government is frankly about bank keeper, keeping banks afloat by keeping property prices high. So with that context, then it's worth looking at the latest data from the Reserve Bank in terms of the credit aggregates. Now, this credit aggregate information came out on the 23rd of December 2020, and in fact almost nobody's reported it, so it's worth just going through the data. And the top level information suggests that year-end credit growth for housing is now at 3.4% compared with 3% a year ago, whereas business lending is now 0.9% over the last 12 months compared with 2.5% growth a year earlier. In other words, housing lending apart, there is no credit growth. So let's look at the monthly data first. And it shows that in the last month, overall credit for housing rose 0.3%. Owner-occupied housing rose 0.5%, and that was offset by investor lending just 0.1% higher. Personal credit was actually flat, But you can see there the trend from recent times when it was in negative territory, and I do expect to see more credit growth from the personal sector as more people borrow more to try and keep their heads above water and also spend more around Christmas. And remember that this data for personal credit does not include buy now, pay later. And business lending was down another 0.2% in the month. Now, of course, these monthly numbers are noisy, but you can see there roughly what's going on. And in summary terms, we can then look at the overall growth in credit, which was a measly 0.1% over the month, slightly higher than previously, but still very low indeed. Whilst broad money grew another 0.9%, again showing the amazing gap between credit growth and the overall amount of money sloshing around in the economy, thanks of course to all the government stimulus and the Reserve Bank's liquidity platforms. Perhaps more relevant is the annualized data. And housing is now growing at 3.4% compared with 3% a year ago. So it is rising, but just a little. But remember that that information will include all of the interest and principal holidays, the drawdowns where people have refinanced and pulled more liquidity out of their property, as well as new loans. And within that, owner-occupied lending is growing at a massive 5.4%. Just reflect on that, thinking that inflation is below 2% at the moment, and income growth is also much lower. So people are getting more and more into debt. Investor lending is down 0.1% over the last 12 months. It is moving up very slightly, but is still very much more anemic than owner-occupied lending. So pretty much all of the momentum in the economy is coming from lending to owner-occupied borrowers. Personal credit is still 12.4% lower than it was a year ago, although it is moving up slightly now. And I expect to see that trend continue in the months and quarters ahead. But business credit is just a measly 0.9% over 12 months and has dropped dramatically. And remember, of course, there was a considerable peak in March and April when COVID first hit, when a lot of businesses drew down on their lines of credit. So the true picture for business investment is even worse than that number represents. And finally, we can look at the growth of overall credit, which is sitting at 1.7%, and that's as low as it's been for a long, long time. When without the owner-occupied lending, it would be a lot worse. And yet, broad money is 12.4% higher than a year ago. So there is a fundamental disconnect between all the liquidity sloshing around in the economy. And if you want in one slide a justification for deflation rather than inflation, it's this slide. The growth in money supply is not flowing through to credit. It's actually flowing into financial markets and elsewhere, but not into the real economy. And that will, I think, lead to more deflation ahead rather than inflation. So, in conclusion, there are considerable issues here with regard to the trajectory of credit. The fact that everybody is banking literally on owner-occupied credit growth. And, of course, that is going to have an impact on housing affordability and indeed on house prices. We'll be updating our scenarios in a week or two. But I do think that that warning from the Reserve Bank about the fact that there are risks with regard to pressures on loans should be heeded and heeded seriously. And in the current environment, I still think that some banks are lending too loose, and we're going to see more issues later. So if you are reaching for credit, remember that the bank may be more willing to lend to you than is sensible for you. And it's important that you do your own due diligence rather than just simply relying on the bank saying, sure, you can have a loan, on the assumption that they've made an assessment that you can also repay the loan. That is a whole different ballgame. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.